Good afternoon, everyone. Welcome to this rundown for global stocks and commodities for the 22nd of April. It was a pretty flat week, which was really surprising given what's going on around the world, but plenty of potential triggers out there. But there really wasn't much movement in stocks or precious metals, copper. Most of those main exchange traded commodities were pretty flat. So this will be a bit of a quicker version today because there's not as much to comment on, but still some really important messages that I think you should be hearing. So the American market, the S&P actually ended up going up 0.8% on the week. It's still stuck within this very tight range, as we'll see in a minute. And the market is only 2.6% off its all-time highs. And when you consider where it's come from since the November election in America, and given the nuclear threats that North Korea poses, and just the incredible language that's coming out of North Korea at the moment, is it's pretty scary stuff. We've also got the French elections today, which has the capacity to be disruptive for markets as well. But I suspect that we'll probably get another reaction if there is a far left or far right candidate elected in France. We'll probably just end up getting a reaction like we did around Brexit, which lasted 2 or 3 days. It was a bit scary for a couple of days, but then it very, very quickly returned to normal. I suspect that we may see something similar this time. So we're not far off the all-time highs. Earnings season still rolls on. I think there's around about 12% of American companies have reported. They're beating expectations by a healthy amount, up around 75%. That's a bit of a game, though, in America, though, because they lower their expectations so that they can beat them. So I don't pay too much attention to that number. But the number that I am encouraged by is the fact that average earnings growth amongst those companies that have reported is about 10.8%. And that's pretty healthy. And that certainly justifies the current PE ratio of the market and the valuations of the market. So with global growth improving slowly, but still improving, with American earnings season good enough, it's really hard to see what could puncture the market outside of geopolitical events. And as I've been covering in recent weeks, geopolitical events don't change trends. They only disrupt the sentiment of the market for relatively short periods of time, generally no more than a few weeks or a few months at the most. Now, just as a bit of an example, I speak from time to time about sector rotation, and all sectors of the market go through that. They're in massive favour for a period of time. They run up, they get a bit overdone, and then they go through a period of either retracement or consolidation at a reasonably high level to allow the fundamentals to catch up. And we've seen that recently. By far the strongest sector in the US over the last 200 days has been the financial sector. And yet, predictably, we're now getting a period of weakness in financials. And over the last month, the financials, which at a medium to longer term level have been by far the strongest sector, are now actually quite clearly the weakest. So I look at that and I see opportunity, because if they're still holding up as clearly a medium to long term strength, yet we've got short-term weakness, then that's an ideal buying opportunity. Of course, unless the fundamentals have changed, and in my view, the fundamentals have not changed. Other recent underperformers that you could consider are energy and healthcare. Now, energy has not been an outperformer over the last 200 days, that's for sure. They've definitely been an underperformer. But nevertheless, they're going through yet another dip. And of course, healthcare hasn't been an outperformer either, but there's still some perhaps buying opportunities. So they would be the areas that where I would be probably focusing my attention at the moment. And just as a general statement, commodity prices are flat, stocks are flat. The most movement we're seeing is really in currencies. That's where the greatest level of volatility resides at the moment. So let's take a look at the S&P 500, and this is the week that was. So they had a full week in America, and you can see we're still in this range between 23, say call it 23.30 and 23.70, and we've been in that range now since there was a bit of a sharp sell-off on the 21st of March. Since then, the markets have essentially done nothing. I was thinking that we could move down into this range here, marked by this green box, which would represent a 50% to a 61.8% retracement of the short-term range. However, that hasn't happened yet. Could still happen, but market's looking remarkably resilient in the face of all that potential nervousness with warships floating around the place. So that's the S&P. Turning now to the Australian market, the Aussie dollar was slightly lower by 0.2, and that's largely a reflection of weaker iron ore and coal prices. It's right at the bottom of the recent range, so unless we get another trigger, either US dollar strength or we get further weakness in the major commodities, then I would expect the Aussie dollar to probably stay in this range between 75 and perhaps 76.5. The ASX 200 index was actually lower by 36 points on the week. And I'll just make a comment about banks. Over the last 5 to 7 years, the banks have had about 4 or 5 significant factors that have been tailwinds for their profitability and for their growth in dividends. And they related to provisions for bad debts. They related to regulatory circumstances. They related to a number of things, and also credit growth in Australia. So it's been a really, really strong period. Now, over the last year or so, those factors that have been significant tailwinds are pretty much all turning around. And so they're going to be headwinds, even if the Australian economy holds up reasonably well, and if the Sydney and Melbourne property markets hold up fairly well as well, so that there isn't an acceleration in property loan stress. Then the really strong gains that banks have had are going to be very hard, nigh on impossible to duplicate. So that's best case scenario. Banks are being priced for dividend certainty in the future. And that may or may not be there. And I hate to buy into something or own something which is priced for perfection, because inevitably something will come along that will disrupt this. So I know that a huge number of people out there have a very significant part of their portfolio in the banks. They rely on the dividends, they rely on the dividend growth, and I'm not saying that is going to stop. I don't know that we're going to see dividend growth, but I'm not necessarily saying the dividends will go down. But gee whiz, there's a lot of risk around that. So just bear that in mind. So let's just look quickly at the Aussie market. Yeah, so the ASX 200, we had a sharp dip just before Easter and post-Easter, which really responded to a bit of a sell-off in America before the Easter weekend, and then we managed to sort of regain a bit of ground on Friday. But other than that, we've got some short-term upside, as you can see, unlike the American market, which has really had a little bit of short-term downside. But we've got this cap here at 6,000, and given that I expect that banks are going to be under a bit of pressure and they're trading towards the top of their recent range, I'm finding it very difficult to see what might drive the Australian market through that 6,000 point level. So it's all about probabilities and likelihoods, and I just can't make a strong case for the ASX 200 to break higher. Now, turning now to precious metals, gold was flat on the week. We certainly did get a bit of a spike up in the week before, and that really put about $30 to $35 worth of what I'll call geopolitical risk into the price. So if we didn't have North Korea doing what they're doing, then I suspect that gold's probably trading at or below their 200-day moving average, which should be around about the 1240, 1250 mark. Now, the fact that gold did break through its 200-day moving average and was able to hold that is a huge thing, because whether you agree with technical analysis or not, the fact is that a lot of people do, and therefore it becomes self-fulfilling. And the fact that gold was able to break above its 200-day moving average will cause buying in the precious metals market. It just will, because that's how technical traders work. There'll be a weight of money shifting in now that gold is back above its 200-day moving average. So to a degree, it creates a self-sustaining situation. Also, too, GLD holdings, so the world's main ETF, advanced further to 849 tons, which is up close to 50 tons this year from memory. I remember when I first started providing these updates very regularly, we were sitting at around about 802 tons, I think. And from memory, that was around about the start of the year. I must check back on the spreadsheet that comes out from the manager of this particular ETF. But there's been quite a build-up in GLD. There was some short-term excess in the gold futures market, and so far that hasn't resulted in any sort of unwinding in gold. But because of that, I wouldn't be surprised if there's a bit of a short-term pullback in gold, but probably nothing too meaningful. Now, silver had been outperforming gold all year and had reached a real excess in the futures market, so it was no surprise to see silver actually go down while gold was flat. It just had to happen because the speculative longs in the futures market were basically at all-time highs, and when you're in that situation, you're on a hiding to nothing that it's going to turn down again. So it's the retail speculators that generally get it wrong at the turning points, and when they're most bullish is generally a time to look for the underlying metal to maybe go the other way. So we'll look first of all at silver, and you can see that we're still above the 200-day moving average, but over the last week we've declined from around about 1860. Closed the week out at $18. But if we turn to gold, first of all on a daily chart, you can see much tighter range there and essentially flat, and it's actually formed a new high. And here you can see how it moved up to the 200-day moving average, the red line, on the 27th of February. It got rejected. You can just look back through here. You can see how important this 200-day moving average is. So we go back to here, we rallied up to it in May 2015, rejected. Rallied back up, didn't quite make it in August, rejected. Rallied back to it in October, rejected. Rallied up to it in February 2016, had a one-day pause and then absolutely blasted through and went on a huge run. When it came back down again in October of 2016, you could see how long it paused around the 200-day moving average and actually tracked it for a period of several weeks. Once we broke through, then there was significant selling until we went back and tested it again in February, rejected, came back up, bounced around there for several weeks, and then we've broken through. So there's no question that it is a key level, and it does become a self-fulfilling situation. There's gold on a weekly chart just to give you a different perspective. Turning now to commodities, copper was down a touch. Crude oil got hit hard on at the end of the week, smacked down under $50 again. I'd been remarking about how oil stocks had been going down while oil was going flat to going up, and that they were probably telling us something about what was going to happen to crude oil, and in fact, that's happened. And now we had a situation where crude oil got hit quite hard, but the stocks already had that downside priced into them, and so there wasn't much reaction from stocks. So longer term investors could start to look at buying dips in some of the largest energy names in the world. I would certainly stick with those stocks, the Exxon Mobils, the Chevrons, those sort of stocks, BP. I wouldn't go into anything more speculative than that because there still could be some more downside in the sector. Now, in terms of current positioning, obviously geopolitical risk both in North Korea, France, and the Middle East remain the short-term risk. How you perform in the market long term is hugely dependent on your emotional control. There's just no two ways about it. And those that have a crystal clear game plan will be subject to emotional decisions, which will be costly. And yet, so many people really struggle or can't be bothered to sit down and nut out a crystal clear plan. And it's it's not that hard, and there's plenty of assistance if you've got the motivation to do it. What I try and do is to focus on sectors which are largely immune from geopolitics, from governments, and from central banks. I've mentioned those sectors over the years because to me, I don't, I want to be less interrupted by those shorter-term external factors, because then significant dips in those sectors will be massive wealth-building opportunities over the longer term. And just to give you a couple of for instances, consider stocks that are tied to the massive growth in technology that we're seeing. Now, I know technology's had an amazing run and it really does need a pullback, so I'm not necessarily saying that you should jump into these right now, but if there is a significant pullback, then I think you could enter with some degree of confidence. And just consider things like the driverless car technology, which is building rapidly. All the Internet of Things applications around the world are just extraordinary. The mobile payments gateways, the businesses there, you've only got to look at the stock prices of the MasterCards and the Visas and those sort of stocks and Chinese internet stocks. You look at gaming and entertainment and the explosion of what's happening in those areas, and also, of course, social networking. Now, just think about those sectors and those technologies and ask yourself whether outside of a short-term sentiment dip, which, of course, happens from time to time in the market, just ask yourself whether geopolitics or governments or central banks are going to change the massive growth in those areas. And I'm sure the answer you're going to get is, well, no, it's not. And so if you can focus your attention on those areas, then you've improved your chances of success. And if you can get yourself a very clear crystal game plan that helps you with your emotional control, then you've improved your chance of success even more. And yes, you've got to pick winners, but there's an enormous amount of profit which is bound up in your ability to reduce the losers or the really bad decisions. And so don't ignore, minimizing the losses as a source of profit, because that's what it is. So that's it for this week. I hope those thoughts are useful for you. There's my contact details for any non-members. And with the French election going on today, I'm sure we'll have yet another very fascinating week ahead of us. That's it. Cheers.